Since the approval of spot Bitcoin ETFs, the price of Bitcoin has been gradually declining, contrary to the expectations of many observers, who anticipated a significant surge, creating a fear of missing out FOMO sentiment. Let's delve into the potential reasons behind the price drop, the selling pressure, and the emerging fear, uncertainty, and doubt FUD atmosphere. In recent days, much attention has been given to the substantial outflows from the Grayscale ETF, GBTC. The GBTC, originally structured as a closed trust and later converted into an ETF, managed over 600,000 bitcoins, which are now being increasingly divested by investors. It's surprising that prior to the approval of ETFs, few had anticipated or publicized the scenario of Grayscale outflows. The in-cash requirement from the U.S. Securities and Exchange Commission, SEC, and more recently, the fee battle among issuers in which Grayscale did not participate, could have hinted at this scenario. Due to the comparatively high fees, it's understandable that numerous GBTC investors are selling their shares and shifting to more affordable Bitcoin ETFs. Additionally, many investors acquired these shares at a significant discount and are now capitalizing on the situation to realize profits. In the initial trading days, Grayscale was offloading Bitcoin worth approximately $500 million daily. Since the approval of ETFs, Grayscale has transferred $345 billion worth of Bitcoin to Coinbase. However, these have been absorbed by other ETF issuers. Both BlackRock and Fidelity now hold over 30,000 Bitcoins each. Nevertheless, the outflows are increasing daily. On the previous trading day alone, Grayscale transferred more than $640 million worth of Bitcoin to Coinbase, taken from Coinbase custody and sent to their brokerage service, surpassing the outflows of the preceding days. Thus, on 3 out of the last 7 trading days, outflows exceeded inflows, potentially explaining the decline in price. However, overall inflows still dominate, totaling over $1 billion or slightly more than 24,000 Bitcoins. Selling pressure from bankruptcy assets. Out of the $345 billion flowing out of GBTC, approximately $900 million is attributed to FTX. The bankruptcy trustee of the defunct cryptocurrency exchange sold around 22 million GBTC shares in the first 3 trading days, realizing profits as well. The GBTC shares from FTX were valued at around $600 million at the time of purchase. The current selling pressure could theoretically ease after FTX liquidates its shares from the bankruptcy estate. However, it's worth noting that there are other cases where a bankrupt company must liquidate its GBTC shares or Bitcoin, thereby maintaining or reintroducing selling pressure. For instance, Barry Silbert, the CEO of the Digital Currency Group, DCG, paid the subsidiary Genesis with GBTC shares to settle Bitcoin debts. These shares now also need to be liquidated as Genesis is also bankrupt. A similar situation arises with Celsius, holding 38,000 Bitcoins, and Mt. Gox, with 200,000 Bitcoins in the bankruptcy estate. In the case of Mt. Gox, emails have already been sent to customers, suggesting that the Bitcoins could be repaid within the next 2 months. Additionally, Bitcoin seized by the U.S. government from criminal activities is occasionally sold. However, these potential Bitcoin sales will not occur simultaneously and do not fully explain the current price decline. Many market observers primarily attribute the decline to outflows from the Grayscale ETF. Yet there are dissenting opinions as well. Sell the news event. The analysis firm CryptoQuant categorizes the price decline as a typical sell the news event. The selling pressure is attributed to traders and owners of substantial Bitcoin holdings, commonly referred to as whales, who are capitalizing on profits following the price surge of the past year, entirely independent of the Grayscale ETF. This interpretation is supported by the net inflows into the ETFs. Grayscale, in the initial trading days, sold over 60,000 BTC, while other ETFs collectively purchased more than 72,000 BTC. This translates to $550 million per day, a value that, according to Adam Back's estimates, is more than 30 times the impact of the halving. A similar perspective is shared by Bloomberg analyst Eric Balchunas. He too believes that the selling pressure stems from traders taking profits. The ETFs have more than absorbed the outflows from GBTC, recording a net inflow of $1 billion. Despite the recent decline, the BTC price still reflects a 75% increase from the previous year, outperforming all other assets. Therefore, fear and FUD, fear, uncertainty, and doubt, are deemed unwarranted. Minor sell-off. Another contributing factor to the price decline can be attributed to the increasing sell-off of Bitcoin holdings by miners. This phenomenon represents a shift in the behavior of miners who have transitioned from the accumulation phase, which characterized the mid-2023 period, to the active selling phase. The turning point became evident on January 15th, when the Bitcoin Miners Position Index, MPI, started to climb, serving as a prescient indicator of potential upcoming sales. CryptoQuant, a prominent cryptocurrency analytics platform, diligently noted this trend, raising alarms across the market. The culmination of this shift occurred on January 17th, when a staggering volume of more than 10,000 bitcoins, equivalent to approximately $450 million, flooded the market, surpassing more than 11 times the typical daily Bitcoin supply. This massive outflow from miner reserves marked an unprecedented event, the likes of which had not been witnessed in over a year. The rationale behind this concerted effort to liquidate Bitcoin holdings lies in the miners' strategic response to the recent surge in Bitcoin prices. With the cryptocurrency reaching new heights in the past months, miners are capitalizing on the opportunity to amass new financial resources ahead of the upcoming April halving. This event, which entails a reduction in the block subsidy, presents miners with the need to prepare for potential rising costs associated with their operations. Beyond fortifying their financial positions, miners are also providing cryptocurrency exchanges with an additional supply of Bitcoin. This influx into the market could have multifaceted implications, influencing not only the immediate price dynamics, but also contributing to increased liquidity and trading activity. The sell-off, therefore, not only serves as a strategic move by miners to navigate the evolving market conditions, but also has broader repercussions for the overall health and dynamics of the Bitcoin ecosystem. Fazit: the current Bitcoin price decline cannot be attributed to a single factor. Instead, it is a combination of miner sell-offs, trader profit-taking, the shift away from GBTC to other ETFs, and liquidations by bankruptcy trustees. With the upcoming halving in April, the Bitcoin supply will decrease. Demand will continue to rise due to ETFs and, of course, the monetary properties and network effect of Bitcoin. The sell-offs by bankruptcy trustees or the US government will eventually conclude, causing long-term demand to significantly surpass supply. This will ultimately be reflected in the Bitcoin price. For those holding Bitcoin for the long term, there's no need to be swayed by FUD, fear, uncertainty, and doubt.